Cryptocurrencies have been tremendously volatile since their inception, but this volatility can open up profit opportunities if you want to trade these digital assets. Cryptocurrencies like Bitcoin and Ethereum have soared since their debut, but like other popular digital currencies, they're well below their highs. Experienced traders have been speculating with cryptocurrencies for years, but how can you get started if you're new to the crypto market? This video will show you just that. First things first. If you want to invest in cryptocurrencies, you need to be in control of your finances. This means you should have an emergency fund, manageable debt, and ideally a diversified investment portfolio. Your crypto investments can become another part of your portfolio that will hopefully help increase your overall returns. Be sure to keep these 5 other things in mind when you start investing in cryptocurrencies. Number 1. Understand what you're investing in. As with any other investment, you should know exactly what you're investing in. If you're buying stocks, it's important to read the annual report and other SEC filings to thoroughly analyze the companies. Plan to do the same with all cryptocurrencies, as there are literally thousands of them. They all work differently, and new ones are created every day. You need to understand the investment case for each trade. Many cryptocurrencies aren't backed by anything at all, either tangible assets or cash flow. This is the case with Bitcoin, for example, where investors rely solely on someone paying more for the asset than they paid for it themselves. In other words, unlike stocks, where a company can increase its profits and generate returns that way, many crypto assets rely on the market becoming more bullish and optimistic so that you can profit. Some of the most popular coins include Ethereum, Dogecoin, Cardano, and XRP. So, before you invest, you should be aware of the possible advantages and disadvantages. If your financial investment isn't backed by an asset or cash flow, it could end up being worth nothing. Number 2. Remember, the past is the past. One mistake many new investors make is looking at the past and extrapolating it to the future. Yes, Bitcoin was once worth a few cents, but now it's worth much more. However, the key question is, will this growth continue into the future, even if it's not quite as rapid? Investors look into the future, not to an asset's past performance. What will determine future returns? Traders buying cryptocurrency today need tomorrow's profits, not yesterday's. Number 3. Pay attention to volatility. Cryptocurrency prices are as volatile as an asset can be. They can drop in seconds based on a rumor that turns out to be unfounded. This can be an advantage for experienced investors who can act quickly or have a solid understanding of market fundamentals, market trends, and potential price movements. For new investors without these skills or the powerful algorithms that drive those trades, it's a minefield. Volatility is a game for the powerful Wall Street traders, each of whom is trying to outspend other cash-rich investors. A new investor can easily be crushed by volatility. That's because volatility shakes traders, especially novice traders who get scared. Meanwhile, other traders can step in and buy cheap. In short, volatility can help experienced traders buy low and sell high, while inexperienced investors buy high and sell low. Number 4. Manage your risk. When you trade any asset in the short term, you need to manage your risk, and this is especially true for volatile assets like cryptocurrencies. So as a new trader, you need to know how to best manage risk and develop a process that will help you limit losses, and that process can vary from person to person. A long-term investor's risk management might simply be to never sell, no matter what the price. The long-term mentality allows the investor to hold on to this position. A short-term trader's risk management, on the other hand, might be to set up strict rules for when to sell, such as when an investment has fallen 10%. The trader then strictly adheres to this rule so that a relatively small decline doesn't later become a crushing loss. Newer traders should consider setting aside a certain amount of trading money and then using only a portion of it, at least initially. If a position develops against them, they'll still have money in reserve to trade with later. The key point is that you can't trade if you don't have money, so if you keep some money in reserve, you'll always have a balance to fund your trade. It's important to manage risk, but that will come at an emotional cost. Selling a losing position hurts, but it can help you avoid bigger losses later. Number 5. Don't invest more than you can afford to lose. Finally, it's important that you don't put more money into speculative investments than you need. If you can't afford to lose it, all of it, you can't afford to invest it in risky assets like cryptocurrencies or other speculative investments. Whether it's a down payment on a home or an important upcoming purchase, money you'll need in the coming years should be stashed in safe accounts so it's there when you need it. And if you're looking for a totally safe return, paying off debt is the best option. You're guaranteed to earn or save the interest rate you pay on your debt. You can't lose on that. Finally, don't discount the safety of any exchange or broker you use. You may be the legal owner of the assets, but someone still has to secure them, and that security has to be strict. If they feel their cryptocurrency isn't properly secured, some traders invest in a crypto wallet to keep their coins offline, so they're inaccessible to hackers or others. Other ways to invest in cryptocurrencies. Although investing directly in cryptocurrencies is the most popular way, traders have other ways to get into the crypto game, some more directly than others. These include crypto futures. Futures are another way to bet on Bitcoin's price fluctuations, and futures allow you to use the power of leverage to make massive returns or losses. Futures are a fast-moving market and exacerbate the already volatile movements in cryptocurrencies. Crypto funds. There are also some crypto funds like Grayscale Bitcoin Trust that allow you to bet on the price fluctuations of Bitcoin, Ethereum, and some other altcoins, so they can be an easy way to buy cryptocurrencies through a fund-like product. Crypto exchange or broker stocks. Buying shares in a company that will benefit from the rise in cryptocurrency regardless of the winner could also be an interesting option. And that's the potential of an exchange like Coinbase or a broker like Robinhood, which derives a large portion of its revenue from crypto trading. Blockchain ETFs. With a blockchain ETF, you can invest in the companies that could benefit from the emergence of blockchain technology. The best blockchain ETFs offer you some exposure to some of the major listed companies in this space. However, it's important to note that these companies often do much more than crypto-related business, which means that your exposure to cryptocurrency will be diluted, reducing your potential rewards and risks. Each of these methods varies in terms of risk and exposure to cryptocurrencies, so you should understand exactly what you're buying and whether it suits your needs. But still, you can always get a financial assistant for these types of situations and get a consultant. This is not a financial advice video and should not be taken as one. We're just showing you the basic understanding of crypto. Cryptocurrency is a highly speculative area of the market, and many smart investors have decided to put their money elsewhere. For beginners who want to get started trading crypto, however, the best advice is to start small and only use money that you can afford to lose. And of course, if you want to learn more about this, subscribe to our channel and ask more about it down in the comment section. We'll see you in the next video, and goodbye.